in this screencast, we're going to look at call ratio spreads and how expert options is going to help us identify the best possible call ratio spread positions in NSE market. First, we will look at a two-slide overview of what a call ratio spread is and then move on to expert options. A call ratio spread is buying one call and selling two further out of the money calls. For example, buy one Infosys December 2008 1200 call at 74 rupees and sell two Infosys December 2008 1230 call each at 50 rupees. So 1230 strike is 30 rupees out of the money compared to the 1200 call. The cost of establishing this position in this case is we actually receive a credit of 26.3 rupees. The maximum loss is unlimited and the maximum profit is short call strike minus long call strike minus the cost incurred in establishing the position. So in this example, this comes out to be 56.3 rupees per option, or for a contract size of 100 options, it will be 5,630 rupees per contract. In this example, we are receiving credit, but there can be cases where we have to, there will be a debit. But in this presentation, we are going to look at the call ratio spreads where we receive a credit. We will also take a quick look at the chart. The chart has the x-axis is the underlying price, the y-axis is the payoff. We have two curves. The blue curve corresponds to the payoff as of today, which is the November 25th, 2008, and the orange curve corresponds to the payoff as of expiration date, the 25th December 2008. On the orange curve, this point where the profit starts going up is the long call strike price. This point where the profit starts going down is the short call strike price, and this is the break-even point. If the underlying price stays below the long call strike price, we are going to have a profit of the initial credit. In the example we saw, that would be 26.3 rupees per option, or a contract for contract size of 100, it would be 2,630 rupees per contract. And if the underlying falls between the long call strike price and the short call strike price, that is between 1200 and 1230, we're going to make more than 26.3 rupees per option profit, all the way up to 56.3 rupees per option. And if the underlying goes above the short call strike price, the profit starts reducing till it touches zero at the break-even point. Our target would be to find out call ratio spreads where this break-even point is as high as possible compared to the current underlying price. So we switch to the export options now. The screen resolution has been set at 800 by 600 to have the best quality of the video on YouTube. Some features may not align properly, so please bear with me. I directly go on to the ratio spread, and export options says there are 126 records of call ratio spread positions, and it has call ratio spreads of various underlyings. I want to look at Nifty call ratio spreads, so I'll set the stock ticker to Nifty and search. Export option shows me 49 positions which are Nifty call ratio spreads, and the column of interest is the upper break even. We want to have an upper break even as high as possible, so I want to sort it by descending order. And so I have the top one I have here. Nifty is currently trading at 2654, and with this combination of December 25th to the expiration date of December 25th 2008, with the spread cost of negative 65, which means I am going to receive a credit of 65 rupees. It has an upper break even of 6,100, which means as long as the Nifty stays below 6,100, I'm not going to make any loss. Rather, I'm going to make some profit, which is really good. But say I get greedy, and that's an amazing position. We can see that right now the Nifty is trading at 2654, and I'm saying if the Nifty is going to stay below 600, 6,100, I'm going to make some profit. So that's an amazing position. There are more such positions. I encourage you to go and explore on expert options. But say I get greedy and I want to look at only the call ratio spreads where the credit I receive is at least 1,000 or more. So for that I said the spread cost should be less than negative 1,000. So search for that. I receive a few records now, and I see the upper break even, so it remembers the sorting order, and it shows me the first record has a spread cost of negative 1470, means I receive a credit of 1,470, and the upper break even is 3,314. So let me jump to the chart, and I will increase the upper range on the x-axis. So in this credit ratio spread, we're buying one call December 25th, 2008, strike of 3100, and then selling two calls, strike 3200, same expiration date, and this is how the profit graph looks. So I am going to make at least 1470 if the Nifty is going to stay below 3100. Between 3100 and 3200, I am going to make more than that, and beyond 3200 but below 3314, I'm going the profit starts reducing, but I will still make profit. But beyond 3314, I will make loss. This is as of the expiration date. So if I want to see the effect of the expiration, I mean the days to expire, as the days to expire decrease, the position starts moving in my direction. If the volatility decreases, the position moves in my direction. The volatility increases, the position moves against me. But as of expiration date, the volatility doesn't matter how high or low. All that matters is what are the strike prices and what is the initial credit I received. That will decide the break-even point. So I'll close the chart. So I just showed one sample call ratio spread on just one underlying. There are more underlyings and more call ratio spreads that you can explore. I encourage you to explore the site. This is with the call ratio spread. I would encourage you to go and explore how the put ratio spread looks. And this is one particular instance, data as of one particular instance. So as you look at more underlyings with your market outlook and you explore other strategies, like the put ratio spread, you will find better opportunities that suit your risk reward profile. In a future presentation, I will also try to cover position management techniques once position is established based on the market changes. Are there things that we can do to benefit from the changed scenario? With this, I conclude the presentation. Thanks for watching. Happy trading.